Welcome to today's Explainer. We're going to be looking at a massive, completely counterintuitive paradox that is just baffling global financial markets right now. I mean, think about it. If I told you there was a live geopolitical crisis happening in the Middle East today, missiles flying, global tensions spiking across the board, you would probably assume the ultimate safe haven asset, gold, was skyrocketing, right? Well, prepare to have your compass broken. 12.7%. Just let that number sink in for a second. That is the staggering monthly decline gold just suffered. And to really put that into perspective, this isn't just a bad month. This is gold's absolute worst monthly drop since the 2008 financial crisis.
And honestly, the damage goes even deeper. The precious metal has completely collapsed, plunging way below the critical $4,000 an ounce mark. In fact, this marks the sharpest quarterly drop we've seen since all the way back in 2013. We are literally witnessing a historic slide in real time.
Which, of course, brings us to the burning question. Why? Why is the ultimate safe haven asset collapsing right in the middle of a live geopolitical crisis? We've got an active U.S.-Iran conflict, we've got severe shipping disruptions in the Gulf, and widespread global uncertainty. Conventional market wisdom practically screams that gold should be soaring right now, but instead, it's falling straight down. Okay, let's dive into Section 1, investigating the collapse. Fear versus interest rates. So there are typically two ways markets digest war. On one side, we have what's called the fear channel. This is where geopolitical panic sends investors running for the hills, straight into traditional safe haven assets like gold. But on the flip side, you have the rate channel. This is where a conflict causes a sudden spike in energy prices, which sparks inflation fears, which then forces central banks to hike interest rates. And right now, the market is completely ignoring that traditional fear response. It is trading this war strictly through the rate channel. Let's actually walk through how this builds, kind of like a row of falling dominoes. The sequence starts with the geopolitical conflict, right? That immediately triggers an energy shock in the Gulf. Then, that energy shock bleeds out into the broader economy, stoking really deep inflation fears. To combat that persistent inflation, we get a highly hawkish Federal Reserve that's ready to keep hiking rates. And finally, because gold pays absolutely no yield to hold it, those higher interest rates make holding cash or treasuries way more attractive, which leads us directly to step 5, the total collapse in the price of gold. Przemysław Radomski over at investing.com really hit the nail on the head here. He notes, the war reaches gold through inflation and the Fed, and that path is bearish, not bullish. Essentially, a strong US dollar and higher treasury yields are acting like a massive steamroller right now, just completely flattening any safe haven appeal gold might have had. And that hawkish Fed is the absolute linchpin in all of this. They are prioritizing higher interest rates to fight inflation at all costs. With US inflation recently printing over 4% and the new Fed chair Kevin Warsh signaling a very tough stance, well, markets aren't pricing in rate cuts anymore. Actually, scratch that, they are now actively pricing in 3 rate hikes this year. When cash pays you a high yield just to sit safely in the bank, holding zero-yield chunks of metal suddenly becomes a very, very expensive opportunity cost. Moving on to Section 2, the global ripple effect, from Wall Street to Main Street. The street-level impacts of this are just fascinating. For instance, lenders in India who issue loans backed by gold, they're feeling a massive squeeze right now as the value of their collateral rapidly drops. Meanwhile, everyday households are playing defense. Companies like Muthoot Exem are seeing an unbelievable 40 to 43% surge in old gold being brought in for recycling. We are talking about a potential 200 to 250 tons of new supply flooding the market. But hey, there's a flip side to the precious metals story. Silver has crashed even harder, down over 50% from its cyclical highs. And while that sounds terrible, it's actually creating massive margin benefits for industrial winners, like solar panel and electronics manufacturers who use silver as a core input cost. It's a real game changer for them. Now, for our international viewers, there is a crucial caveat here. Currency layers really matter. Domestic gold prices don't always move in lockstep with the global charts. For example, Indian MCX gold actually bounced recently to 142,750 rupees. Why? Because the weakness in the local rupee acted as a cushion, offsetting the dollar-denominated decline. It's a fantastic reminder that your local currency often dictates your actual reality. All right, Section 3, the hidden gold floor, diverging global data. Now, what's really interesting here is the massive divergence right now between the visible market and the hidden market. Over in the visible market, the headlines are screaming about record-bullying ETF outflows, and central banks, led by Turkey, are net selling their reserves. It looks like a total exodus. But look at the hidden market. Over-the-counter data shows a near tripling of private and semi-official Chinese gold imports, driven by incredibly strong Eastern demand. This is exactly what happens when you only read the headlines. If you only factor in the massive Western ETF outflows and central bank sales, you are going to severely overestimate the severity of this crash. A massive share of global demand hasn't vanished at all. It's simply moved into private channels that report with a lag. And that is effectively putting a hidden but very sturdy floor under the price of gold. Furthermore, not all of that visible selling was purely about interest rates anyway. As Dan Coatsworth from A.J. Bell points out, investors often sell what they can in the face of trouble, and gold is a liquid asset. Early on in this geopolitical conflict, a lot of this selling was just a blind rush for liquidity. Investors were taking hits elsewhere in their portfolios and just needed quick cash to cover their positions. Which brings us to Section 4, rethinking your portfolio. Is gold still a hedge? Here is the absolutely crucial takeaway for you today. Too many investors treat gold as an automatic hedge, like a magic rock that always goes up during bad times. But it's actually a conditional hedge. It does a phenomenal job protecting against currency debasement and long-term fiscal deterioration. But as we are seeing unfold right now, it performs terribly when inflation concerns drive nominal interest rates higher. So, what should you do today? Well, experts at Fidelity still suggest maintaining a 5 to 10% strategic allocation because that long-term fiscal protection, it's still highly relevant. But for the near term, you absolutely must watch the macroeconomic triggers. The single biggest one right now is the upcoming U.S. payroll and unemployment data. If the jobs data comes in strong, that reinforces the Fed's rate hikes, which could push gold down to test support around the $3,740 mark. But if the jobs data is weak, that might force the Fed to pause, potentially triggering a really sharp short covering bounce. And that leaves us with one final and perhaps most important question. If gold's safe haven status is strictly conditional, what is protecting the rest of your portfolio right now when the fundamental rules of the market suddenly change? Take a really hard look at your asset allocation in this high-rate environment because the old playbooks simply aren't working anymore. Thank you so much for joining me on this explainer. Keep learning, keep questioning, and I'll catch you next time.